6. Initial mindset and expectations. What really is trading? Trading is often mentioned among online earning methods, but what is it really all about? Nothing strange. If you are trading, you are approaching the world of finance. I already anticipate that, although this ebook is the bomb, it alone is not enough to make money from trading. No video on trading alone would suffice, even if it is 2 hours long. You have to study, prepare and backtest, so you create a strategy and test it in the past to see how it performed previously, and then start testing it in steps. Study plan creation. Backtest, forward testing. Scaling trading is a gradual path. It is not that thing where you put in €200 and it magically becomes 200,000 inches. No. Forget all the fluff and start completely from scratch. Trading means trading financial instruments. 7. When do you do it? When it is convenient. What is being exchanged? Now we get it. Types of trading. Trading can be done by buying and selling financial instruments of all kinds, e.g. bitcoins, currencies, stocks, etc., and there are many ways to do it. Depending on how long you keep an operation open, you can be a investor. You work in the long term by putting money in shares, in a bond or in several shares, creating a diversified portfolio and wait 20, 30, 40 years before liquidating everything with a profit. Don't aim for resounding performance in the short term, but perhaps maintain a performance of 0.9% per year with a long-term view. This is the first thing that we advise you to do for your personal finances. Whether you want to trade or not, you have to save and invest. If you are interested in the subject, we invite you to explore it further by doing some more research on the subject, as it is not what we will be covering in this course. 8. Swing trader. You work in the medium term and have operations that you keep open for days or even weeks. Day trader. You work in the short term with positions that you open and close within a day, potentially within hours or even minutes at certain levels. This type of financial speculation works with very short price changes. When we no longer talk about investments but day trading, knowing that the latter takes time is essential. It is not an activity that can be done occasionally or sporadically. It requires commitment and dedication in terms of time. It is impossible to get rich quickly with trading, so immediately abandon the idea that it is an opportunity to easily earn money in a few minutes a day or a month. 9. How much money and how much time? Trading is a profession. It is a type of work where, yes, money can be made. The gain is potentially unlimited. Time. The problem is that you are very unlikely to succeed. Why? Because the ones who succeed are the ones who never give up and who put in consistent discipline and perseverance every day for years to study, test, backtest and optimize the strategy over time. As a day trader, you don't have to chart all day. You can even spend only 2 to 3 hours per chart. It depends on your strategy. But it should not be done to make a lot of money right away, but rather with the goal of being consistent over time. Day trading is a marathon, not a sprint. 10. So what does the money that can be made from trading depend on? There are 3 variables that influence how much money you will make. The soundness of your strategy. You have to check that your strategy works in the past and in the present with good performance. Market conditions. The market will not always give you favorable conditions. Your performance is highly dependent on market conditions, on events that will happen in the future, and you have no control over that. Your mental performance. The degree of concentration, focus, discipline and performance you can maintain over time. Trading is a performance-oriented job, and performance can vary over time depending on your strategy, how it performs according to the market, your focus, how well you stick to your plan and risk. Revenues are, therefore, also variable. If you are not already advanced and well capitalized, forget the idea of drawing a fixed monthly salary from trading. As in every business, enterprise, method, company, there is the possibility of closing a month in the negative or at break-even. 11. If you are not financially and emotionally ready for periods of drawdown, loss, or do not set out to become one, forget it, this job is not for you. So, you can understand that the person who tried to tell you, quit your job and get rich today thanks to trading, had nothing but his own interests at heart and was profiting from your naivety. But don't worry. We've more or less all been there. There is no more financially unsound choice than leaving your job, especially if your only source of income, to start trading without experience and capital to spare. If you have no money to spare, know nothing about trading, and only have one job, it is the perfect time to start studying how to create a strategy, backtest it and start planning your finances and trading. 12. But you have to be smart with your money, not throw it all on a crypto, bot, or broker and hope for the best. That crap is a recipe for your psycho-financial collapse. The essentials to learn: risk management. Strange but true, before talking about trends, supports, graphs, and more, you must fully understand risk management. Risk management. Why? Because with trading, you put your money at risk. If it wasn't clear, I'll tell you again: your money, which you have worked so hard to earn or slowly put aside. You have to treat them properly, not throw them around in the market. The relationship between risk and opportunity, between risk and potential return, is the bread and butter of a trader's work. Every trade or transaction you open risks a portion of your capital because you expect to earn a certain amount with a higher probability. 13. But the potential return, you don't decide. The market decides it if it agrees with you. You have limited control over the yield. Things that you do not control. The market. Things that you can control. Your risk. The only thing you can and absolutely must control is your risk. How much to risk? The first thing you have to do is preserve your capital. Just don't lose money, and you already do better than 90% of traders. Risk management is to be observed in a maniacal manner. 14. The process to follow. Perfect. I've studied a little bit. Now I can stand in front of the chart and press buy to see the money grow. I almost even copy the trades from a nice signal room. Here, this is the approach that leads you to instant failure. The first thing you have to do is study, study, and study. Then you have to create a trading plan and apply it as if it were law. As far as the study part is concerned, we obviously recommend that you evaluate practical training, even better if it is live, with someone who shows you how they apply their process and strategy, someone with whom you can confront. One of, if not the best options available in the trading education landscape is us. Click here to find out more about our training courses. Instead, there are different analytical schools on which concepts to study. Again, our advice is to focus on one thing at a time. However, first understand how prices and volumes work. This is the basis of day trading. Then, optional but highly recommended, you can understand how macroeconomics works, i.e. the fundamental analysis, aspects of a particular financial instrument or the world in general. 15. Then, of course, there are purely fundamental analysis strategies that are more long-term for position trading. Because, in the short term, prices do not always move for fundamental reasons. They may also move for emotional reasons in the market or for rebalancing the portfolios of large traders. Some strategies rely mainly on the fundamental and then use the technical analysis part to look for confirmations. However, these are somewhat more long-term strategies than day trading. You have to become a technical analyst, but be careful because even on technical analysis, there are different schools of thought. You have probably seen the classical technical analysis around, such as trend lines, market figures, and Bollinger Bands. Personally, we have been trying these things for quite some time and feel that they are completely useless for day trading, or, rather, useless when used alone. To build a trading strategy, it is important to analyze prices, so-called price action, and volumes, so-called volumetric or order flow, well. This is the most functional and where you can find the most statistical advantage. In this course, we will learn how price works and how to construct, based on how price moves, strategies that have a statistical advantage, also referred to as the edge. Win rate. We will now look closer at statistical advantage and how it is constructed. 17. What you need to learn in the beginning, the ABCs. Let's begin to understand how trading works by starting with the fact that you have to buy or sell. Buy or sell. What? Financial instruments. Financial instruments can be of 1001 types, but you absolutely must choose the ones you specialize in. Financial instruments. Forex. CFD. Equity. There is Forex, which is the currency market. Commodities, which are the raw materials. The stock market, the shares of various companies, and many other markets, such as bonds, etc. These are our asset classes, i.e. our market types. But how does the exchange take place? I have to buy gold and barrels of oil. 18. Physically and go and change my euros into dollars at the post office? No, that would be impractical and functional, so you use pieces of paper or contracts. These contracts simulate the price movement of assets such as Forex, commodities, equities, etc. and can be of different types. The most popular are CFDs and futures, two very different types of contracts. Usually, beginners use CFDs because they have lower capital entry barriers and offer more leverage. Beware, leverage is not necessarily a good thing. It can be a risk. Futures, on the other hand, are more professional instruments that professionals use. They have higher entry barriers and lower available leverage, but if we want to do volume analysis, we can only do it here. Futures are only traded on an exchange, so we have access to all the transactions that have taken place. Who bought, who sold, and how much they bought or sold for. This information is very useful for volume analysis. Conversely, CFDs are traded all over the world, so we will not have access to transaction volumes. We will have to rely only on the price chart. Even if volumes are important, you can still do a lot with price action. 19. If you would like to learn more about volumetric analysis in the future, click here to access the free course we did on the Stealth Retail channel. Fewer barriers to entry. More leverage, not always a good thing. CFD. Decentralized, unreliable volumes. More capital to enter. Less leverage. Futures. Reliable volumes, one exchange. I hope you liked this video. Kindly like, share, subscribe to this channel for more amazing videos.